Welcome to PharmaSource, recorded at CDMO Live 2025. This episode is brought to you by Qualifies, the platform that helps life science teams streamline audits and predict site risks with AI-driven insights.
So welcome, everybody. I think it's really been a fantastic day, and it's a real pleasure to be here with everybody. I want to thank the organizers, I want to thank the sponsors, and I certainly, before we get started, I want to thank my fellow panelists. We spent hours and hours and hours and hours preparing for the session today so that we would be spontaneous, and I'm very much looking forward to the discussion. The title for the panel today is Follow the Money, How Private Equity Capital Flows Are Reshaping the CDMO Landscape. Look, maybe we could all agree, or maybe not, that the inflow of investment from private equity has absolutely accelerated the growth of the sector really in every way. One of the questions, though, is, has there been too much growth? Has there been not enough? Or is it just right? Let's just jump in. We'll do a few speed rounds to really get the conversation flowing, and then we'll go ahead and do a round of introductions. But speed round, question number one. In the world of PE investing, the goal is steady, predictable growth, while also knowing that faster is better. What does it take to deliver fast and predictable?
Shall I go first?
Yes.
Good afternoon, all. Thanks for staying late. I think one of my conversations this morning, a gentleman was saying a pharma has a commercial relationship with the site, not with the company. So as long as you run a great site, which is reliable, dependable, so the pharma would move with the site, not with the company. So I think running great operations, at the end of the day, it's CDMO, right? While PE funds invest in across different sectors, the quality, the dependability, the assurance the site can give is really important.
Dirk?
Another aspect to that, by the way, I fully agree. And there's tons of examples where actually the site was first with the pharma and then moved to the CDMO. But another aspect which I think has been crystallizing over the last 10 years or so is bring a good strategy in place. Make sure the CDMO stands for something. For example, focused on VMS or focused on liquids injectables, and is not all over the place. So put that vision into place, put that strategy into place, and make it a market leader in a subsegment. Not everybody can be a Lonza, playing in all fields, but having something in place which is unique and which is a dependable partner for the industry, I think that's more important than total scale.
Vishnu, bring us home on question number one.
I believe the PE companies need to continue to invest in operational excellence, right? Minimizing the risk, driving scale, driving compliance, and eventually enabling technology to be implemented in your organization. And I think that was something that previously companies did not really think about or have a strategy to actually execute against. So I think continuing that type of mindset will kind of help the steady growth of a CDMO.
So now let's go back in our minds and think a little bit about history. So what did you like least about the good old days of CDMOs back in the early 2000s?
Potentially the easy availability of pharma carve-out assets, simply because at that time it went hand in hand with a naivete in terms of deals. But at the same time, that also sparked the interest of private equity. So it's a bit of heaven and hell at the same time. I think that has changed considerably as of today. So I think we're facing a very, very different world when it comes to carve-outs than 20 years ago.
Very good. We'll keep going this way.
Yeah, I can't go back 20 years, but I think, back...
Look at you. I just think I got called old.
I think, back in the day, there's a lack of investment for customer experience, right? I think it's really focused on revenue growth, scale, trying to find assets to carve out and acquire. And I think in the late 2010s, we see CDMOs really focusing on the customer experience, project management, pre-sales. So I think that's something that I've seen, that kind of evolution within the industry.
Awesome.
I'm going to echo what Dirk was saying. The genesis of CDMO as an industry was carve out of pharma assets. So they were literally synthetic startups. So they're not new companies, but old companies, but new companies, because they're coming out of pharma. And most of the early private equity investors in CDMOs were not life sciences specialist funds, which we have a plethora of today. So they were all business services investors who, like any B2B business, had a steady, sticky, long-term contract. Now, today we have specialist funds like Archimed, Ampersand, who operate in every node of the drug development value chain, so they appreciate the pain points and the nuances. So yeah, when they started, not specialist and synthetic startups which carved out of pharma with long-term contracts, that made it appear that life is easy. So yeah.
So before my life clock expires, just a couple of more questions here. So we talked about what did you like least, about whatever the good old days means for you. What did you like the best? What do you wish was happening today, maybe that isn't happening right now in CDMO land?
Well, I mean, it goes along the same lines, because I think, as I mentioned earlier, I figured it was a bit of heaven and hell. In the past, it was this naivete, but today it's the lack of opportunities. So a lot of, and that keeps also valuations at a relatively high level, because finding the right asset that fulfills the right requirements for your customer needs is something where private equities are becoming more choosy. And at the same time, the assets are becoming less available because there's a lot of competition around them. Matching the asset in a good buy and build platform strategy for private equity is becoming increasingly difficult.
Very good. Asif?
I'll go back to my earlier point. So when you would buy a Novartis selling the site, it came with a 5 to 10 year contract.
Yeah.
So the BD was embedded in it. So today, if you ask any BD person today, the senior professionals who we meet here at the conference, they are fighting with several other BD professionals for that piece of work. So that would be nice to have again.
I'll talk about kind of in the 2010s, like the biotech boom in Cambridge, Boston, where we really saw that PE money flow into Boston, which resulted in a lot of outsourcing to CDMOs, which was a great time for all of us. I was in sales during that time, so it was, hey, you can definitely hit your revenue targets and grow quite a bit. And we're seeing that dip in investment recently in biotech startups and biopharma, which is resulting in probably some revenue challenges for the CDMO sector today in underutilized assets, which is likely leading to PEs actually targeting these underutilized and undervalued assets to help them kind of grow within the sector. So I definitely miss those days in Boston, Cambridge, where every company had a lot of money to spend and wanted to outsource their R&D all the way to their commercial manufacturing.
Very good. Well, now you know a little bit about each one of our panelists. I want to give them an opportunity to take a moment and introduce themselves so you can learn a little bit more about them, and then we'll get back to our regularly scheduled program. So, Asif, kick us off, please.
My name is Asif Shahinshah. I'm an executive director at TH Healthcare and Life Sciences. TH has been around for 24 years. We'll complete 25 years this summer. We are what an industry calls lower mid-market boutique M&A investment bank. We've done several transactions in the drug development value chain, CROs, medical device design companies, CDMOs, pharma commercialization businesses. So here, meeting some interesting prospects. In terms of my personal background, before TH, I was at Pharma Ventures, further upstream on biotech licensing and spin out of sites. Prior to that, I was with a large family office on the buy side and spent time with Citigroup in New York and Citigroup in Asia. Longer than 20 years.
I'm not that young, by the way.
It's all up here, right? That's what I tell myself.
Vishnu Dwadasi, Director in Life Sciences at West Monroe Partners. We're a full-service management consulting firm focused in digital. Our M&A practice is quite mature. We do over 200 deals annually in the healthcare and life sciences space. I focus on the pharma services side and CDMO. Prior to consulting, I was in the CDMO sector, starting my career at Catalent Pharma Solutions, working at Bioduro, PII, and did a short stint at a biotech startup where I led manufacturing. So excited for the panel today.
Well, yeah, thanks. Actually, my experience apparently lasts also longer than 20 years back, so Kurt, same boat here. Dirk Beyer, actually, for an investment banker, I actually did study something, a PhD chemist by education, but a very long time ago. Spent 10 years at BCG, and then now more than 20 years in M&A, so that gives you an idea. Working at Raymond James as a managing director. There's two colleagues of mine here in the audience as well. Raymond James is a full-service bank in the US, a pure investment bank in Europe. We're 3 managing directors only in healthcare in Europe, covering the broader value chain of healthcare. I think we're around 20 MDs in healthcare in the US, so it's actually a pretty sizable team in investment banking and healthcare. Probably my first or one of my first deals was actually doing the carve-out from an AstraZeneca asset to a small investment boutique in Germany, which was called ICIG, and essentially that was the nucleus for Corden Pharma. So it was the first transaction, and Caponago followed, and a couple of others. And at that time, predicting that this would become a larger than 2 billion sale to Astorg, ultimately, was far beyond our means at that time.
So was that when telephones still had wires and there was rotary phones?
You remember those little purple telephones from Nokia? I think that was the time.
Very good. Well, again, I think we have a fantastic panel here.
Kurt, your intro too, your background.
Yeah. Okay. I'm Kurt Nielsen. You think you know somebody. I also have a PhD in chemistry. We had to come all the way to Rotterdam to learn this about each other, so I'm having a moment here in front of everybody, so welcome. 30 years in the pharma business. Really everything that I've worked on in my career is about bringing new products to market, from idea all the way through to commercialization, and then rinse and repeat. I've had the good fortune of working at J&J, Teva, was at Catalent, took the company public back in 2016, and then was at Sandoz, Lupin, and then PII. So thank you very much. Next time you'll host the panel. So let's get into it, folks. This is a jump ball question, so I'll take a volunteer who wants to go first. Anybody want to go first?
Without the question? Okay.
Yeah, that's what makes it interesting. Okay, so here's our first question. What is your view of the PE firm's behavior in CDMO world today? Bulls or bears? They're doing LBOs or they're reinvesting cash flow? Do you see big mega deals or small carve-outs? What do you see as the behavior today, and what do you think your outlook is?
I'll be a little bit pedantic here for a second. If you look at a private equity investor, why are they buying a business? So it's like buying an apartment which you have rented out. So you have a tenant generating regular rent, and you want the rent to go up at regular intervals, like 10% per annum or 15% per annum, and you want the value of the apartment to go up as well. So that's an acceptable behavior by any financial investor in a capital markets setting. So that's what a PE investor or PE fund wants in an ideal investment scenario. Want the revenues to grow, the cash flows to grow, and the value of the business to grow as well. But the life doesn't work that way. Obviously the market conditions change, the yield situations change. If they have levered to acquire the asset, things change. So because they're financial investors, their goal is to maximize their financial outcome. And if you're fortunate enough, if you have a good team which has operational nuance and the knowledge, and they have the great operating partner, then they can come along with you in the ride. But if they can't offer you that, sometimes they are bad marriages, right? So we see a few situations where PE investors who just got greedy because it became glamorous for everyone to invest in healthcare, they don't have a strong DNA to invest in a a CDMO business. So that is one subset of current situations we are seeing. And then there are other PE investors who are mature, who have seen several cycles, who have other portfolio companies at different nodes of the drug development value chain. They're with you, they add value, and they are bullish. They see this as a buying opportunity, the dips in the market. And if you're a founder looking to exit the business now, if you find a right PE partner, it's still a good time to do a transaction. You probably might not get the multiple that you would get in a bullish market, but you'd rather transact now before it's burn your bridges with the commercial growth opportunity that you may have.
Very good.
Yeah, the PE firms that I typically interact with are focused in the mid-market, and what we're seeing is cautious optimism, right? I think there's a long-term opportunity in the CDMO space. A lot of our clients are looking at undervalued or underutilized assets and trying to bolt on to assets they currently have in their portfolio to actually put together kind of a CDMO network and integrate them into that one CDMO feel for customers. And even though the market has turned a bit, PE clients of ours are focused on investing in the business from the technology side, trying to build their sales team, marketing teams to grow and scale the business as well. So I think there's cautious optimism. I think there's opportunity now within the sector to bolt on. So I think a lot of companies are coming to us, hey, what are some good targets in the sector? Not just in CDMO, like, hey, can we buy a pharma testing lab and augment what we're having as capabilities? So I think we're going to see this continuously for the next few years, but I think one thing to highlight is they are willing to invest in digital transformation, which is historically something not seen, and I think that's going to drive efficiency and eventually being able to leverage AI, which is going to be really change the industry as a whole.
Yeah, I can only chime in. I think if you're looking at going back in history a little bit, what you saw in the first upcycle of the CDMO industry and the first building of CDMO networks was a relatively carefree assembly of assets. So also private equities were buying facilities, they were taking in, also because you get these carefree contracts from Big Pharma, which would guarantee you that for the next 5 years you would actually be fine if you didn't screw up. That has matured massively up to today, and it comes back to my earlier argument with strategy. I think today you are looking at much more in general, much more educated private equities that are really interested in building a platform, and they're also far more interested in integrating the assets into the platform. So I would argue that earlier assets were far less integrated, and I know of cases where like management was done via Excel sheets being sent back and forth, and that's something you rarely see today. There is usually with a good private equity in the background, and there are private equities which have specialized on this. You see the strategic focus, you see an integration, you see an attitude of not scale, not at all means, but a dedicated scale in a certain technology, in a certain area, in a certain indication, really depending on the customer needs. And I think that is one of the big changes in the current upcycle. Is it currently? I would agree with cautiously optimistic, and that comes as a trade-off, unfortunately, because if you're looking at pharma services as a whole, looking at the CROs, they are currently at I would call it a down cycle, and that might be a transition on also when CDMOs will see the down cycle in maybe 5 years when the pipelines start depleting because the investment has not going in there, but currently in building the CDMO networks.
So when we think about what makes an asset investable and how investors think about how they capture value, not just how they create value, what's your view on what's going to drive valuations in the next year or two? Is it going to be the macroeconomic environment and the availability of capital at a low cost? Is it going to be, at the other end of the spectrum, it's, look, the macro in terms of the amount of work that can be done by these companies is going to continue to grow. And so because the growth outlook is so good, that's what makes the sector an attractive investment, or is it something else?
I think 12 to 24 months is still short to medium term. You said 1 to 2 years, right? And like in every industry, every 2 or 3 years, there's going to be a flavor of the season. So we are seeing demand for high potency capabilities or radio pharma or some specialist cell and gene therapy, right? So if a team can bring regulatorily robust capabilities around these, where the high demand areas are, and then also deliver bread and butter business on FDF and other areas, and an operating team with experience, I think they are set, because the outsourcing is a genie out of the bottle. You can't put it back. It's pharma is not going to internalize all the manufacturing. The geography of it might shift. The supply chain geography might shift, but the concept of outsourcing is irreversible. So that's a secular trend. So you're riding the secular trend, but with some tactical wins, if you have those capabilities, and the team is of course important. If you assemble a great team, I think you can do really well in the next 12 to 24 months.
Just to add to that, I think it's important to diversify your revenue streams, right? Expanding different services, like we talk about pharma testing services or radio pharma, however you want to build your CDMO network. I think to add to that, you also have to think about not relying as much on a few big contracts, right? I think a lot of CDMOs got caught, especially during COVID, that we had a few large commercial contracts, you have a supply chain issue, and now your revenue stream is depleted. So I think if you show that, hey, we have a strong pipeline, diversification, not of just our services, but our client base, I think that really shows value to a PE that, hey, we're resilient in any type of economic situation, and we can help scale and then the PE can come in and help you scale the business as well.
Yeah, let me step back a little and look at what is actually valuation. Valuation, in a very simplistic investment banker kind of perspective, is actually what's your operating result and what's the multiple you apply to it. And that implies what Asif was just saying. If you're running good operations, you will always have a good operative result. And B, the multiple an external buyer will apply to this, of course, depends a little bit on the flavor of the year, of the month, but it also depends on how the investor looks at the macroeconomic environment. And I think there's an undisputed trend for, this goes now beyond my time, more than 30 years, that the pharma industry is actually outsourcing manufacturing. It's not a core competence, and that will continue. And as long as the pharma industry as a whole is growing, we could probably extrapolate that the CDMO space will be growing as well. So from a fundamental perspective, that's a positive. Challenges you have is, of course, reshoring investments you'll need to take, tariffs that may have an impact. But I think all of those are easier to foresee and to overcome. And therefore, the private equity industry is more challenged by finding the right assets from which to build platforms or to add to platforms than to finding the money in order to do that.
So when we think about other externalities that will impact what makes these companies investable, I think no conversation today would be complete without talking about volatility. And something that I've seen in my 30 years in the business is that the rate of change has accelerated to a point where almost on a daily basis, there's either some new information or lack of information that makes it easier to do nothing. And in the do nothing, there's volatility. And what is your view about how this volatility, will play out? Because the reason why I'm asking this question, just based on the commentary so far, is that this idea of, and I've subscribed to this my entire career, you run a good business. You bring in great people, you support them, you put the systems and processes in place, and so long as the macro environment is stable, that you'll be able to outcompete your competition and grow. That to me is a question mark today. Do you see it as a question mark, or do you see it as an advantage?
I think we just need to acknowledge, what the economist and political scientist used to call peace dividend, right? So the peace dividend is going away, and I mean, I don't want to say there's a World War III coming. The world is not a static place. The societies, nations, and the economies, they go through their own turbulence. So there is not a single industry or a single business which hasn't seen any volatility. So volatility is part of the game. If you come to the table, it would happen at some time or other. The elephant in the room is tariffs, right? The elephant in the room is the geopolitical risk. I mean, India, one of the key component of the supply chain is just almost started a war with this neighbor. Yeah. And we have a Russia-Ukraine war going on. We have US and China. But despite all of that, patients are still getting their cancer therapy delivered. But as a CFO or a CEO of a business, it's incredibly difficult to have a no turbulence flight ride. It is challenging. So there is no getting around it, right? So with regards to tariff, we spoke about it, right? So what is going to happen? There is no clarity on margins. So any acquirer who we are advising, and Dirk, they're pencils down. I don't know how to price the asset, right? But this is not going to be a permanent situation. It would change, if not in a few weeks, few months, right? If not in one quarter, a few quarters. So for a brave investor, I see there's an opportunity. Whenever things are uncertain, people are superbly cautious. There's an opportunity to invest in. But for an operating head of a business, lead of the business, whenever things are uncertain, you got to stick to the basics. So if you can afford to stick to the basics and not panic, there is a reward at the end of the panic cycle. Sorry, long answer.
But it'll be interesting to hear to get your perspective on it too. Like, I think there's panic out there.
To some extent, yes.
Yeah. I'm not saying it's justified, but I think there's some panic out there. So.
Yeah, I think from like the CDMO perspective, if you're a COO or CEO, there's panic, right? About your supply chain, how that impacts margin, how that impacts drug supply for your customers and commercial supply agreements, et cetera. But on the PE side, I think it's an advantage, right? Hey, maybe I can get, again, like an undervalued asset or a panicked CEO or another panicked PE company and make an acquisition. And hey, I know I'm going to hold this for 5 to 7 years. In this time frame, in this panic, I have capital. Let me invest in the business, get back to basics, build the strategies to actually gain the competitive edge. So, 5 years from now, you continue to be resilient, you can scale your business and eventually find your exit. So I do think there's opportunity here, but there's a lot of fear in the market as well. So I think it's going to be challenging.
Yeah, when you talk about finding your exit, it feels like the theater's on fire. Yeah. So even though it's not, right? It's all kind of.
Yeah, I mean, like with every crisis, there is like a chance attached to it. And I think the chance right now is for many private equities. I mean, only the largest ones are really global private equities. So there is many private equities which are European and then have a like little suburb in the US and vice versa. So what does that actually mean is there's still a very regional approach to it. And so it comes to pass that they are actually building more regionalized networks in an environment which is still regulatorily relatively safe. And it's less important to be transcontinental international than it was maybe 5 years ago. So that could be an opportunity today, but that can also change very quickly. I mean, I'm not sure who recalls TTIP in Europe as a free trade zone with the US. This was negotiated under Obama and died due to some chicken. It was called the chlorine chicken in Germany. Once something like that materializes, suddenly internationalization becomes a very, very big topic again. And with the current administration in the US, that is as well in the cards as 100% tariffs. So I think the safe bet private equities are running today is focus on regionalization, but also the flexibility to very quickly change the strategy and go back into full-scale internationalization if necessary.
What's your favorite history lesson over any time period with which you've had your illustrious careers? It's almost a bit of sharing wisdom would be another way that I can ask that question.
I was working for Citigroup in New York during Lehman crisis. And I recall there were brave investors like Warren Buffett who invested in Goldman Sachs, and he picked up a few other securities as well. Everyone was panicking and running like headless chicken. And people who have seen a few of these cycles, they went in with their checkbooks open. And it was like picking up gold from the surface instead of mining. So I'm not saying we are in a situation as worse as 2008 financial crisis, but the lesson is when there is crisis, people tend to gather around a calm or a calming person. So if the founders can stay calm, if the financial investors can stay calm, the fundamental of the fundamentals of the pharma value chain remain. So that's the lesson from me.
Within the CDMO sector, we see a lot of carve-outs. I had the opportunity to join Catalent when it was carved out of Cardinal Health the same month, and what I learned during the carve-out, as a consultant and as actually being part of it as part of a employee, is it's extremely challenging to be part of this carve-out integration effort. And as a leader of a CDMO, even as at every level in the business, it takes quite a bit of effort to make sure you're integrating and getting the right change management in place to ensure that you actually can leverage this new asset to scale the business, right? If you are making this acquisition or carve out and you just let it be, you're not really fully utilizing this asset. And then also you might have some other cultural challenges as you try to integrate. So really focus on the change management. Having that calming presence as a leader will help with this, because I think when that happens, there's a lot of fear and uncertainty. But I think, these are part of how CDMO transactions happen in today's world.
Yeah, for me, it's also like it came a little bit with the Lehman crisis. At that time, I had just co-founded my own little M&A advisory boutique, so perfect starting time. Plus, AstraZeneca came up and was divesting their facility for Gordon Pharma. And I was standing there saying, "Oh boy, we're never going to make that." Macroeconomic environment seemingly collapsing. A pharma giant that more tried to dispose of an asset rather than build something off it. A purchaser at that time not really well versed in pharma. But what it taught me was stay true to the vision. If you believe in something, you can make it happen. And eventually, we all know how the deal went in the end. And it turned out very nice, and until today, I'm grateful that I could have a part in that.
Fantastic. And when we started the session, we did an audience poll and asked them their view about the impact of private equity, and was there too much growth, was there not enough growth, or was it as Goldilocks would say, if you know that fairy tale from the U.S., is it just right? And there was a lot of hands that went up and said it was just right. My last question for the panel is, in terms of PE investing in CDMO land, do you think our best days are behind us? Do you think it's today, or do you think there's still to come?
I think there is still a lot more to come, and it's in the form of non-specialist PE investors disposing their ownership to specialist PE investors, and they can deploy more capital. I think the growth is going to come from reallocation and new capital coming in. Yeah, that's where I see it.
There's a whole other panel discussion on that, but okay, that's fantastic. Go ahead.
Still to come. I think really with digital transformation, AI, analytics, we're going to see just a different way of operating and a different way of scaling the business. And it will require training and upskilling staff to be able to leverage these technologies. But I think that journey is going to almost start now, and in the next 5 years, the way that we operate as CDMOs will change significantly.
So I'm the party pooper a little bit. I would say...
Oh, we were almost there.
We were almost there. No, it's actually... I think we're in a cyclical industry. And I think we're currently seeing a plateau. I think it might go down over a time span of 5 years, particularly when you look into the biotech pipelines. I mean, I think this is the worst biotech investment year in the last decade. And it just has started. So where are the products coming from that CDMOs are actually going to bring to market? I think most of the investment from big pharma currently flows in securing supply and less into R&D. But it will change. It will turn around again. And like all those bumpy roads go, they go up. So if you put a straight line through the bumpy road, then I would say, yes, best times are still to come. But in between, there will be significant bumps down. And I think we might face one in the next 3 to 5 years.
Very good. Well, I want to thank our panelists. I always learn a lot, but it's important to listen and stay calm and have an optimistic outlook. That makes a huge difference. I want to thank the conference organizers and our sponsors. Without their support, we wouldn't have the opportunity to share what I would call some invaluable individual and collective wisdom. So thanks again, and everybody have a great evening.
May I interrupt you and thank you for taking the leadership on this and having the sessions, the prep sessions, and for your wisdom and guidance. Enjoyed working with you for this panel.
Fantastic. Very good. Now it's time to go have some drinks on a boat.
Yeah.
It is indeed. A very, very big thank you from our team to Vishnu, to Dirk, to Asif, and to Kurt as well for expert chairing of a really interesting session and a great way to finish day one of CDMO Live. And of course, a big thank you to TH Healthcare and Life Sciences too for the sponsorship of this session.
For more external manufacturing insights, head to cdmolive.com and download our 50-page summary of the event. Make sure to book your ticket for CDMO Live 2026, taking place the 27th to 28th of May at the World Trade Center, Rotterdam. We look forward to seeing you there.